Hi, I'm Veronica Wasek, and I help Shopify sellers to set up, organize, and streamline their financial systems with confidence. In this video, I'm going to explain to you what is cost of goods sold and explain it to you from my perspective as an accountant. So as you may know, I specialize in Shopify accounting and I work with a lot of clients. And the challenge that we typically see for our growing clients is trying to get good numbers for cost of goods sold. My clients are dealing with either tracking inventory and cost of goods sold on spreadsheets, using apps, using Shopify inventory, and they're really struggling to put all of the pieces together. So I thought I would explain to you what cost of goods sold is from my accountant's perspective and how it should be calculated. So let's go ahead and take a look. Let's start with some terminology. Inventory are the goods and products and the raw materials and component parts used to produce those goods and products that are ready to sell. Sometimes it's called inventory on hand. COGs, or cost of goods sold, are the expenses directly related to the production of goods and products that have been sold. So we are recognizing or expensing cost of goods sold once the inventory has been sold. And landed cost is the total cost of goods and products once those goods and products have arrived at the seller's doorstep, including transportation, customs, duties, taxes, tariffs, insurance handling, and more. And typically when we are costing or expensing cost of goods, we generally want to use landed costs. There's a direct relationship between inventory and cost of goods sold. So think of them as cousins. If inventory goes down, cost of goods sold typically goes up. Because if inventory goes down, that means that we sold inventory. So once we sell inventory, we have to recognize cost of goods sold. So cost of goods sold would increase. But we have a disconnect. As an accountant, what I see is that we have textbook accounting for how we need to track inventory and cost of goods sold versus the reality. The textbook accounting tells us that we need to have an inventory formula, which I'll talk about in a moment. We need to look at valuation, how we will value that inventory, and it's all about perfect numbers. Everything needs to reconcile. And then on the other hand, we have what sellers are really doing, the apps that are available to give us the information that we need in order to capture the right numbers from an accounting perspective. And really, we have limitations in technology right now in the e-commerce space that make it more challenging for smaller sellers and growing sellers to capture the information that we need from an accounting perspective. So let's talk about the inventory textbook accounting. There's a lot that goes into valuing inventory and cost of goods sold, and here are some of the things that you need to know. First of all, we have the inventory accounting formula. And basically what that means is that there's a methodical way in which inventory and cost of goods sold should be calculated, and in particular, cost of goods sold. The formula for calculating cost of goods sold is beginning inventory plus purchases minus ending inventory equals cost of goods sold. Then we have inventory valuation. And this is how we're going to value the inventory. The general methods available for inventory valuation are landed costs. FIFO means first in, first out. LIFO, last in, first out. Weighted average, and lower of cost or market. And then you have the inventory system that you will use to track your inventory. Whether it's a periodic inventory method, meaning you'll adjust inventory on a monthly basis or quarterly basis or annual basis, or a perpetual method in which inventory is being updated real time. Also, for accounting purposes, we have to consider that there are components of inventory. So starting from the top, you'll have vendor and supplier deposits. These are monies that have been advanced to vendors for inventory that hasn't been received yet. And then to the right, you have inventory in transit. And that is the inventory that is on its way to you as the seller. So you can't sell that inventory yet because you haven't received it. Then at the bottom, you have what we call inventory on hand. That is the inventory that you have in your possession or in a warehouse that can be sold. But that inventory may have been paid for already, but part of that inventory, depending on your vendor terms, may be unpaid for. And those are things that we have to consider when we're doing the accounting. And then you have inventory that has been sold. Now let's go through a very simple example of inventory accounting. So let's say that you received inventory. You received 10 units. The landed cost for that inventory was $50 a piece. So you have $500 in inventory. Now let's say that you sold 3 units out of those 10 units, and you sold them for $75 each, and your income is $225. When we look at inventory, then we have increased inventory by 10 units. The cost was $50, so we're increasing inventory by $500. And then we sold that inventory, so we're decreasing inventory by 3 units by the same $50 inventory cost, and decreasing the inventory balance by $150, which then gives us 7 units on hand at $50 for $350 in our inventory balance. For cost of goods sold purposes, then we have 3 units sold for $50 cost each. Our cost of goods sold is $150. So as you can see, the same amount that we deducted from inventory flows over to cost of goods sold. And remember I said there's that direct correlation between inventory and cost of goods sold. So in that perfect accounting world, everything reconciles. But we have some challenges, and actually a lot of challenges, when we're dealing with Shopify inventory and really e-commerce inventory. We're dealing with a high volume of transactions. You can't really track cost of goods sold for each transaction, and certainly not in QuickBooks or generally not in accounting software. Then you're dealing with your inventory costing. You have varying costs. You have landed costs. Prices are increasing. Your inventory cost is changing over time. And then we have disjointed data. We have data from Shopify, from your fulfillment center, from purchases, from sales. Everything lives in different places. Your inventory data is not integrated with your sales data. And many sellers are just using manual tracking methods, which makes it even more challenging because, again, we have data that is disjointed. So if you're a Shopify seller, you might have noticed when you look at your finances summary that there's an amount that says cost of goods sold in the finances summary. Can you use that amount for bookkeeping? Well, there are some limitations, and really I would have you steer away from using that number because of the following. First of all products in Shopify must be updated for landed costs. And so if you're not keeping track of your costs in Shopify, you're not updating those balances, then you're not going to get good numbers. There's also no correlation between what's being tracked by Shopify and what's actually being recorded on the books. And the Shopify cost of goods sold calculation is not based on the inventory accounting formula that we talked about earlier. So if you'll remember, for the inventory accounting formula, we have beginning inventory plus purchases minus ending inventory equals cost of goods sold. So in this case, we have beginning inventory of 10,000, purchases of 5,000 less ending inventory of 2,000 equals 13,000 in cost of goods sold. The amount that we see on the finances summary for cost of goods sold has no correlation to the inventory accounting formula. The way that Shopify is calculating cost of goods sold is just the quantity of inventory sold times a cost. You can't just update the cost of goods sold amount because it has a direct relationship to the inventory balances. And therefore, both cost of goods sold and inventory balances have to be correct. So in order to truly track cost of goods sold, we have to at the same time be tracking inventory using this inventory accounting formula. So what's our takeaway? The books are only as accurate as the inventory and cost of goods sold balances that are used. So if you have bad inventory numbers and bad cost of goods sold numbers, and if those numbers don't reconcile using the inventory accounting formula, then you'll ultimately have inaccurate financials. Are you struggling with calculating cost of goods sold? Let me know in the comments. I'd love to hear from you. If you're looking for a trusted and reliable Shopify accounting pro, check the description below to learn more about my services. And check the description below to learn about all of my resources, including my free Shopify bookkeeping blueprint, the link to join my Facebook community, and my online academy. I'm Veronica Wasek. If this content is helping you, then subscribe to my channel, ring the bell, and give me a thumbs up. I'll see you next time.